So I think for the first time in a long time, we actually have, risks of a fiscal spiral that higher interest rates can feed to large deficits, which can then feed to more inflation, which can then keep those interest rates elevated and basically cause ongoing sustained inflation, or to the extent that they're able to get inflation under control for brief periods of time, those are likely to be kind of recessionary conditions. And then if you try to stimulate out of the recession, inflation is likely to come back. So I think the 2020s environment is going to be quite different in that regard than the 2010s environment.
Lyn Alden, founder of Lyn Alden Investment Strategy and author of the new book, Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. It is so great, Lyn, to welcome you on the show. Thank you so much for joining me today.
I appreciate you having me.
Well, I appreciate having you on because I have to say, Lyn, you are one of the most requested guests that I get from my viewers. And so it's just an absolute honor to have you on today. And Lyn, I'd like to start before we dive into the book, where I always start with my guest, and that is to get their big picture macro view. What is that macro picture for you today? And I'll give you as much time as you need to set the table, if you will.
I think we have a couple conflicting forces right now that history gives us a guide to, but of course not a perfect playbook for, which is basically that we're in what Ray Dalio would call a long-term debt cycle. There are other names for it. I've spent years researching it, looking into it. It's been very useful, not just in a theoretical framework, but for example, predicting inflation that we've had in recent years. And what that means is basically we spent the past 40 years constantly cutting interest rates to, whenever there's a recession, which helped get debts higher and higher and higher. And eventually we ran into the global financial crisis, big private debt, blow up, interest rates hit zero, and we pushed a lot of that up to the sovereign level. And so now we're in kind of the later phases of it when we've been at zero interest rates for a while. Now we're trying to get off zero. We've done that, but that's blowing out the fiscal deficit. Basically we've had years of rising public debt to GDP and falling interest rates, which is kind of offset each other. But if you go forward in a world where those deficits are not being offset by falling interest rates, even if they're not going up, if they're just going sideways, that fiscal situation starts to look emerging market-like. It starts to look like a fiscal spiral. And so that's kind of the situation that much of the Western world finds itself in at this time. And at the same time, there are geopolitical realignments. There are new technologies out there related to money and things like that. And that's normally how these things go. Sovereign debt crises lead to kind of changes in global orders. Global orders lead to changes. They contribute to sovereign debt crisis in the first place. These things tend to feed on each other. And new technologies for money tend to emerge when the prior monetary systems run into blow up. So basically, each one of these sovereign debt crises usually results in a very different type of structure. So for example, the past crisis was during the U.S. Civil War. That's kind of when we started shifting from a free banking system more towards a central banking system, even though it didn't really fully take place until the early 20th century. But they started centralizing the banking system. The telegraph made that more possible. Then with the Great Depression financial crisis, that shifted us more towards this modern era, kind of the Bretton Woods, and then eventually the kind of the Eurodollar standard, the fiat currency standard. And these things tend to go in these big cycles. And so that's kind of the overall framework that I'm looking at now, is that basically we're in this kind of fiscal environment that most market participants alive today, at least in the developed world, have not been familiar with. And you either have to go back to the 1940s in the developed world for a similar playbook, or you have to look at emerging markets, or at least some emerging markets in the past several decades.
I would love to hear more on that, because I know in the book you also mentioned 1940s. Can you take us back to that time frame? And I suppose, is that how I hear that's how you're kind of analogizing what we're going through now? Just to elaborate a bit more as to what was, maybe that backdrop and how it's similar to today.
Sure. So during the 1920s, there was a big credit boom. So the amount of broad money and credit and total debt expanded a lot more quickly than the base money. It was leverage. And that all eventually hit ahead in 1929 and began to collapse. And even cutting interest rates to zero was insufficient to re-blow that bubble. So it actually started to fully collapse. And that lasted for a number of years until 1932, when they decided, okay, we basically have to print now. And so they expanded the monetary base, bank holiday, but the problem is you can't, if your monetary base is backed by gold and you just expand the monetary base, you're going to have a problem with your gold. So then they repriced gold. They made gold illegal to own in the land of the free. They recapitalized the banking system. But what that did is that kind of put America into like a economic malaise for a period of time where the crisis was over, but there was like this period of slow growth, private sector deleveraging. Some of the leverage was brought onto the public sector. And then you had a long period of rising populism. And of course, that was happening in Europe as well. That was happening in other countries. And that populism in multiple countries eventually contributed to World War II. And then we had kind of the second phase of this crisis, which was a gigantic public debt bubble across the developed world, large amounts of money printing. Unlike the Great Depression, that was more outright inflationary. And what they did in the 1940s in the US was they did yield curve control. So they said, okay, I mean, inflation's averaging 6% this year. I mean, this decade, inflation reached as high as 19% year over year in the United States, which was higher than even the peak of the 1970s. And yet they held interest rates roughly at zero, and they even pegged the long end of the curve at 2.5%. And so if you were holding bonds or cash, you just got completely killed on a real basis, even though you got paid back every dollar. And that's basically how they recapitalized themselves. They, if you were holding debt, you basically got defaulted on in real terms. And then we entered kind of that next era. And there's certain similarities today, which was during the 2000s decade, there was a gigantic credit bubble relative to the monetary base. That all blew up in 2008. They recapitalized the banking system by expanding the base money for the first time at that speed since the 1930s. That was a kind of a disinflationary crisis because you had a partial debt deleveraging, you had some money printing, but you didn't have a big increase in the broad money supply. And then, we had this decade-long period of rising populism. You had Tea Party, Occupy Wall Street. You had more and more political division. Just kind of an era of politics that was, very different than, kind of the middle of this past century, for example. And then, there's eventually some sort of catalyst. In this case, it was COVID. But when something like that hits a highly levered, highly polarized system, you get, bigger than normal responses to it. It looked a lot like wartime financing, a lot like the 1940s, which is why I began making that comparison so much. And so we've been in this era where now it's more inflationary. Now it's more the broad money supply itself is being inflated, or at least was until very recently. And the debt is now fully a lot of it's on the sovereign level. So you get to the point where if you have over 100% debt to GDP, interest rates become a more mixed tool for fighting inflation, because in addition to higher rates pushing down private sector credit growth, which is disinflationary, they also completely blow out the fiscal deficit, which tends to be more inflationary. And so the ability of central banks to fight inflation gets harder. I think a way of phrasing it is that most of the tools that central banks have are designed to accelerate or decelerate credit growth. And they don't really do anything about fiscal-driven inflation. And yet that's what we've had. And at a certain point, there's so much debt that their tools that affect credit growth can actually make the fiscal side worse. And so we that's why I think we're in the later stages of this overall kind of long-term debt cycle.
And that would be the fiscal spiral. I marked that in the book, that section. Is that the fiscal spiral?
Yeah, the fiscal spiral is when you have higher and higher public debts as a percentage of your economy. And importantly, they're no longer being offset by declining interest rates. And so if you look back over the past several decades, during the late 80s, early 90s, that was the prior period of the public zeitgeist was very focused on the debt because you had huge deficits, you had high interest rates, and so the interest expense relative to the size of the economy was very large. And so the infamous public debt clock, the national debt clock, went up in New York in the late 1980s. Ross Perot ran the most successful independent presidential campaign in the early 90s, based primarily on the debt and deficit. And so that was kind of the peak public awareness concern about the debt. But they ended up being 30 years early because we had the opening of China, the fall of the Soviet Union. And so we had 30 years of kind of disinflation, globalization, Western capital coming together with Eastern labor and resources, connecting cheap Russian gas to Europe, a cheap manufacturing out of Asia for the whole world. And so we had this kind of 30-year period then of falling interest rates, disinflation, and so that helped offset any sort of ongoing public debt to GDP issues we've had. But the problem is now is that once you hit zero and you start to bounce off zero and go sideways to up in terms of interest rates, while you still have very high public debts and deficits, we're kind of back to that early 90s, late 80s period. But this time we've squeezed more juice out of the orange. So there's less ability to kind of have another wave of doing that, kind of pushing it away. And so I think for the first time in a long time, we actually have, risks of a fiscal spiral that higher interest rates can feed to large deficits, which can then feed to more inflation, which can then keep those interest rates elevated and basically cause ongoing sustained inflation, or to the extent they're able to get inflation under control for brief periods of time, those are likely to be kind of recessionary conditions. And then if you try to stimulate out of the recession, inflation is likely to come back. So I think the 2020s environment is going to be quite different in that regard than the 2010s environment.
Yeah, that's quite the conundrum then. Do you think, is there anything that could be done to address that, or is that just kind of like the situation we find ourselves in?
I mean, I think a lot of things could be done decades ago. I think once you get to this point, it's kind of like, what do you do at stage 4 cancer, right? It's the further you let this metastasize, the worse the treatment options get, the less effective most of them are going to be. They have provisions, for example, to just recapitalize the balance sheet. I mean, they can literally revalue gold, for example. It's one of their only methods that they have on their books to create money without associated debt attached to it. It would be highly inflationary, highly destabilizing. But then if you basically inflate a lot of debt away, you could then normalize. You could then get to a structural period of positive real rates that are actually sustainable. But it would also have killed confidence and killed, cash and bond holders on a real basis. So I think that this is just one of those things that's going to be an ongoing multi-year kind of slow motion train wreck. And, sometimes people will say that sounds doomy, but it's, for example, I spent the summer in Egypt. I go there every year, and I was there during a period of 37% official inflation, and life went on, right? And so some of the things I describe headed our way in the United States, for example, people will say, well, that's doomy. And it's like, no, that's a normal Tuesday for like half the world, and even less bad than that, right? It's like, these are just things that developed countries go through in history, emerging markets go through more regularly, and some of the things we're experiencing now are in line with those unusual periods, and they're just different than the past 30 years or so. And so we just have to make sure that recency bias doesn't catch up with us, and to make sure that we're not, I think, overly kind of triggered by things that sound extreme but really aren't in the grand scheme of history and the grand scheme of the world. And that even in unusual macro situations, life goes on. People are still going to work. They're still going to restaurants. They're still out there hustling. Life finds a way. But it's just an unusual environment that the last 30 years are not very instructive toward. And yet that's most financial professionals, that's their experience base. That's what they're going on when they kind of predict what happens in the future.
Give us a bit more of a taste of what it's like. You mentioned spending summers in Egypt and the 37% inflation. Like, what kind of conversations do you have with folks over there about just the cost of living or that kind of inflation? How do people adapt?
So I because it's my area of focus, I tend to ask a lot of questions for my friends and family there to understand the nuances of how things work. It's been interesting to see how prices and money supply kind of push through the economy. Basically, the way that most people function is they try to save in real estate, which is illiquid. They try to, and there's like a lot of empty apartment buildings or empty homes around, just because people will literally save in real estate, even if they don't know exactly what they're going to do with it in the future. It's considered a type of malinvestment, but that's one of the things they try to do. There are people that will literally build their house like brick by brick. Like whenever they get a little bit more savings, they'll get more bricks and they'll add like, the second floor to it. Or they'll add like the outer, finishing to it or something. And it's kind of like your savings are slowly building your own property. I know, for example, there are literally like physicians that will hold American cash dollars like under their mattress that they bought on the gray market. And that's like just a normal thing that some people do there, right? Which is kind of astounding in the 21st century that's kind of the situation they find themselves in. Because if you're in a situation where your money supply is growing by 20% a year, you're now in this kind of like treadmill race. Like if you're not increasing your wages by 20% a year, you're getting diluted as a share of this whole monetary network. If you're not doing something with your savings that is either getting an interest rate that is comparable to that inflation rate or money supply growth rate, or you're putting it in much scarcer assets, real estate, gold, dollars, it's just hard. And a lot of people there don't have easy access to foreign capital markets. They can't just go out and buy the S&P 500 if you're a normal working class person. And so it's just kind of this treadmill that people find themselves on. And then you kind of even small businesses, like they're trying to figure, okay, so the price of like imported wood has doubled. Do I try to pass it on to my customers now? Do I just cancel that product because it's not going to be successful in the market at the current time? Or do I raise prices like half this year and just take a massive margin hit and then try to finish the price increases next year? And so the inflation is just a constant kind of error in the overall signaling mechanism of prices. And so, there's different environments. Like, for example, there's outright failed states, and then there's other ones where it's just an ongoing background problem that you live with. Sometimes it flares up and gets worse. Sometimes it gets better. But it just kind of shows the distortion in money that people have. And really, we actually have the same thing in developed countries. It's just much, much lower, right? Everything's kind of dialed up. It's doubled or tripled in those types of markets. So we still have the same issue with the fact that our money supply grows by 7% per year. So it's always on, the burden's always on the people to try to keep reclaiming their share of this monetary system lest they get diluted. And the anchoring bias is always in favor of the status quo. So if you're the one trying to change your wages, if you're the one trying to raise prices, you're kind of going up against this dilutionary force. And the same thing happens in these developing countries. It's just that instead of 7% money supply growth, it might be 15%, it might be 20%. In some cases, it might be 30% or more. That's when you start to get kind of outright disarray. And it's just, it's very illustrative because I think a lot of people, especially a lot of macro investors or analysts or Wall Street types are very kind of buffered from a lot of what this looks like in the real world.
Hey there, I just want to quickly interrupt the video and just say thank you. Thank you so much for coming to this channel and choosing to watch this interview. I hope that you are enjoying it and I appreciate you visiting the channel. If you like what you see, please hit that subscribe button. It doesn't cost anything. It's totally free and it will keep you up to date on all of my interviews. I post 2 interviews a week with some of the most incredible people in finance and investing, and your support will help me bring in some more amazing guests. If you already are one of my subscribers, thank you so much. I cannot express to you how much your support means to me. I am incredibly grateful that I get to do something that I'm truly passionate about. And you being there week after week, it not only gives me that energy, but it just gives me that faith to keep going. And it means everything to me. And I love seeing you all in the comments section. I love interacting with you. I love interacting with you on email or social media. I just love hearing from you all. And I just appreciate your support so much. I feel incredibly lucky that I get to do something that I just love. So I just want to say thank you and appreciate you subscribing. All right, back to the interview. Before we dive further into the book, just want to go back to the situation here in the U.S. And when I'm listening to you, are you expecting a recession, or talk to me how the this long-term debt cycle, like where we are in it. I expect it's probably part of it. You get a crisis within it, but I want to hear your thoughts there.
So one of the challenges with the fiscal deficit is that if we get a recession, normally tax receipts suffer in that environment, both because asset prices are falling and because unemployment levels are rising. And yeah, we're already running a $1.7 trillion deficit going into it. So if we do get a recession, the interest expense portion of the fiscal deficit will ease, most likely, but the other parts will worsen. And so I expect more of like a stagflationary type of condition. And another way of phrasing it is that we have a tale of two economies. If you're not an interest rate sensitive sector, you're either booming or at least you're fine. If you're a upper middle class retiree that has a very large cash balance, money markets, T-bills, and either no debt or fixed rate mortgage locked in, you're fine. And if anything, if the Fed increases interest rates, that just means more income for you, right? And so that's not going to affect your travel. It's not going to affect your ability to go to restaurants. Some of them even help their kids and grandkids afford their kind of first property, things like that. So you have some degree of just kind of things that are happening there. On the other hand, if you're in commercial real estate, if you have credit card debt, if you're a junk rated business, if you're a small business relying on bank loan financing, many of these businesses are very much pressured by this higher rate environment. And so, and this actually goes back, if you look at it, recessions in emerging markets, they often look different than recessions in developing countries. Instead of like this big uniform thing, you have, okay, this one sector, like these exports, and they're booming, and this other sector is completely stagnating. And I think that's what we're going through here, where it's very sector by sector, whether or not you're harmed by higher interest rates or you're on the right side of the fiscal deficits. That's kind of the delineating factor. And overall, like I expect higher average background levels of inflation, which can go down in a recession. It can go up when you're coming out of a recession, but that the average is basically higher than the 2010s. Just because there's these higher background fiscal deficits. And so right now we're seeing mixed results when you look at most metrics. So most economic indicators have been decelerating from a positive base since late 2021, which is roughly how long it normally takes. Right now it's kind of getting long in the tooth, but it's roughly the 18 to 24 months of deceleration is normal. And some of them indicate mild recession. But other ones are turning back up. Like they're actually showing signs of stabilization from a low level. So if you look at purchasing managers indices, if you look at conference board leading indicators, some of these are actually turning up from a low level. And that's because we just have a very unusual environment. So I take things on an industry by industry basis. And I generally have a more stagflationary type of outlook. So for example, I don't think the S&P 500 is going to do very well this decade in real terms. From its late 2021 high, right? I think that's, instead of the market going straight up like it did to the 2010s decade, I think it's going to be a choppy, volatile pattern. And then especially when you count for what is CPI doing, what you can earn in T-bills, it's just not going to be an attractive market overall because the economy is more in this kind of stagflationary type of situation.
I think stagflation, that environment it's historically the worst for not only stocks but also bonds, I believe.
Well, this was the worst 3-year history in bonds ever. I mean, basically going back to like the founding of the United States, U.S. government bonds have never done this poorly. If anything, the most useful thing in my portfolio has been just not being long bonds. I've had somewhat mixed equity selection success. I've had somewhat mixed, certain things are mixed, but the biggest things have just been getting the big picture right on macro, which is expecting inflation, avoiding long duration, low interest rate bonds, and focusing more on either equities or cash or gold or Bitcoin or commodities, energy producers, things like that. that's been the winning strategy, and that normally works in a more stagflationary or inflationary environment. And of course, again, there nothing is linear. So even in the 70s, there were disinflationary impulses within an overall kind of very inflationary decade. And that's the challenge of navigating this. But yeah, I think having that stagflationary outlook helps you gear your probability weightings in your portfolio to avoid the assets that do the worst.
Lyn, I also just want to turn to the book, and I'll just start with a very wide open question, and I'll let you go again as long as you'd like. And I have to say, I'm enjoying listening to everything you're saying. Just incredible wealth of knowledge. Let's just start with why is money broken, and how did we get here?
So the main thing I would say is a technological shortcoming. That the way that I describe it in the book is that there's a couple different eras. So up until the invention of the telegraph, matter and information moved at the same speed, more or less. So humans could not transmit complex information any faster than they could travel on ship or horse. But once we invented and then deployed the telegraph, which didn't really happen until like the 1860s, and then continuing from there, at that point we could send information around the world at nearly the speed of light, while physical settlements and physical matter could still move slowly. And if you can send information, you can send transactions. And so we completely decoupled the speed between transactions and settlements. And so that allowed for a lot more, and it even necessitated credit abstraction, things like that, because some entity, when banks around the world or entities around the world are basically updating each other's ledgers electronically, and yet they're still expected to settle in gold eventually, that gets arbitraged with IOUs. And that became very centralized, very abstracted, and eventually broke because it was a very fragile system. One of the references I cite in the book is Jevons' 1875 book, The Money and the Mechanism of Exchange. And he's talking about how this system is super efficient and increasingly centralized, and in some ways beautiful, but he's like, this is also levered 20 to 1. If 5% of people ever show up and want their gold back at once, this whole system runs into a brick wall. And of course, that's what happened in World War I. And so they basically the whole system broke. And so for the past century and a half, we've been in this environment where transactions go a lot quicker than physical settlements of sound money. And so we've increasingly decoupled from sound money, eventually just dropped it entirely. First it was like, okay, credit grows faster than the base money, and then it's okay, break the pegs, change the pegs, and then it's just disregard gold entirely and just keep it as kind of a reserve asset on balance sheets somewhere. And we've just kind of had takeoff. And the way I would describe it is the first time in history where we've taken a step back in terms of monetary hardness. So for most of human history, we're going up the hardness scale. We were going from shells to copper to silver to gold in terms of what we use as our money, and basically getting scarcer, slower supply growth types of monies. But with the fiat currency era, speed became an issue for the first time, and so we actually took a step back in hardness in exchange for more speed, more centralization, things like that. And so the kind of the summary of why it's broken is that there are 160 different currency bubbles in the world because this current system relies on centralization and abstraction. And so in any one of these currency bubbles, they control all the firewalls around the border of the country, and people are kind of just stuck in whatever currency environment that they're in. Like we covered Egypt before, you happen to be born in an environment where there's 20% money supply growth. People can get the elites can get foreign capital, they can get offshore accounts, they can get all these kind of tools, while the majority of people find themselves continually diluted in that system. And so that's why money's broken. Basically, that we've decoupled any sense of soundness because the transaction speeds have gone up so much. And of course, there's a lot of bad decisions along the way. Certain central bankers, certain politicians, they make very bad decisions with how they manage their ledgers. But one thing I point out in the book is that every country in the world dropped the gold standard. Every single country in the world uses fractional reserve banking. Every single country in the world has inflationary monetary policy. And when you see something so ubiquitous, that's more than just a moral failing. It's like a technology failing. It's like an incentive failing. Basically, things have kind of gone in that direction because there's not really been other good ways of doing it until perhaps recently. And so in this world, there's all these different currency bubbles, and just money is it's lagged compared to, we've gotten way better at energy production, way more energy abundance per capita in the world, way better technology, the electronics, software, so many things have progressed very quickly over the past 50 years, for example. But our money systems are still antiquated. The SWIFT system's 50 years old. The fact that a physician in Egypt for savings is putting American cash dollars under his mattress in the year 2023 just shows how that the money system's not really caught up with some of the other things that we are accustomed to.
Why do you think it is so antiquated, or why has it not caught up? What is that underlying reason, you think?
I think a lot of it's network effects. And so network effects are very slow to change. They take a long time. Even when you have better technology, it still takes a long time to pierce into a prior very powerful network effect. And of course, this network effect is associated with states themselves. So governments, it's not just disrupting an industry, it's disrupting how governments rule their countries. And also, it's, only in the past 15 years or so have there been the technologies to even go around this. And so, for example, the invention of Bitcoin, the invention of stable coins, and things like that are the first things that really pierce the borders. And so, for example, when you think of a financial border, there are really two ways to bring capital in and out of a country. One is through physical ports of entry, so airport, for example, and they secure those very tightly. So, you generally can't bring more than $10,000 worth of cash or gold through an airport, for example. If you do, you need certain authorization to do that. And the other one is basically bank wires. And so, for example, any incoming or outcoming money into the country is through bank wires, which are highly government regulated. And so any given country has a pretty firm lock on the foreign currencies coming in, the currencies that are leaving, capital inflows and outflows. And what things like Bitcoin and stablecoins do is just completely bypass that. So, for example, you can send someone money as long as they have the internet. If you're able to email with them, direct message them, have a video call and show a QR code on the screen, you have ways to just pay money in or out. And then, of course, even if a person can literally memorize 12 words representing their Bitcoin private key, and they can bring any amount of money through an airport, and then later reconstitute their ability to access the Bitcoin network as long as they have an internet connection. And it's impossible to prove they have or don't have that. And so that's just a different world of money, but that's a world that has only existed for 15 years and has really only existed with sufficient liquidity and size for about 5 years, because it's kind of started out like a venture, a low liquidity experiment. And really only in the past, 5-6 years has it actually reached liquidity to begin mattering at that scale. And even then, it's still small. So I think it's mostly a matter of time. It's mostly a matter of network effects. And that's just why money changes more slowly. Another way to describe it is that software keeps bringing down gatekeepers, so it brought down traditional book publishing. You can just, easily go around that now. It brought down traditional media. Right now we're having just a peer-to-peer TV show, basically, that's all the different ways of communication and media production have gone around the gatekeepers largely due to technology software. And that's now coming for money, securities, finance. But it just took longer because the ability to do that is more sophisticated. It takes more complex, bandwidth, infrastructure methods, and you're going after state control rather than just corporate control, which is just an overall harder thing. It comes later.
Yeah. Wait, did you self-publish your book? Because the reviews have just been phenomenal, and I feel like everybody's talking about your book.
I did, yeah. So I had a bunch of publishers reach out to publish it, and I surveyed. I talked to a lot of people I know that have published books, both traditionally and self-published. In many cases, both. And I was trying to figure out what I should do. And the unanimous opinion was, with the platform I have, why not self-publish? I literally, I basically I have a media company. Why not publish it through that? And generally what traditional publishing does is it gives you a little bit of distribution, not much, but it gives you some distribution. It also, for authors that can't just front their own costs, they need an advance. It's useful for that role. It hooks you up with editors and things like that. But with my kind of financial situation, I don't need an advance. I can front all the costs. I don't want to be I don't want to give up any rights. I don't want to be confined with a word count or things like that. I want to pick my own cover. And then ironically, I found a much better editor by hiring one myself than whatever I would have been assigned at a traditional publisher. So my editor is himself, like in addition to editing the work, Joachim Book, he has a master's in economic history from Oxford, and provided research assistance and fact checking for the book. And so, yeah, it was a self-published book, but that it is at a scale and a caliber that would compete with any sort of, kind of traditionally published book. And that's just available today. It's just a changing world.
I love that. Yeah, I found out about the book from Twitter, and I don't remember who was tweeting about it. And I was like, I need to buy it. So yeah, I've just seen phenomenal reviews. So I love that, Lyn. I also want to just explore with you the role of the US dollar and the challenges that come with that status as the global world currency. I know you have a few chapters on that. I was hoping we could flesh that out as well and maybe get your outlook on, I guess, the role of that currency, of our currency going forward.
So in a world where we go back to the prior problem of gold is no longer settling quickly now, in a world where it's the world needs telecommunication speed settlement, but gold itself is not providing that, you then need an abstraction layer over it, some sort of ledger that different countries are using in order to settle with each other. And just like any kind of money is like a market good, it has to compete with other monies in the region. When we have 160 different countries in the world, well, more than that, but 160 different currencies in the world among nearly 200 countries, those currencies are competing with each other, and you basically recreate barter, right? So if there's all these different currencies, then every country has to kind of manage, okay, which currencies do I want or not want? What do I do with the currencies I get from selling my goods and services to them? And so because of liquidity and network effects and scalability, it tends to concentrate in a handful of bigger ones. And so it used to be the British pound. They had the strongest network effect around the world. They could kind of serve as the world ledger in many aspects. And after World War II, that shifted over to the United States. And so the United States is, the dollar is 90%. It's involved in 90% of global FX conversions. Something like 60% of international transactions. I forget all the numbers, but it's a dominant force across the board because it's kind of the glue that connects all these other fiat currencies together. And that gives the United States significant, kind of advantages in the sense that they can sanction countries and cut them off from that network. They have extra monetary premium on their currency. So multiple people around the world want to hold dollars for lack of a better other money to hold in many cases. And so that kind of extends the runway of the U.S. to be able to run deficits without triggering currency crises. It doesn't give you unlimited amounts, but it extends the amount that you have. But the downside of that is that if there's so much extra demand for your currency worldwide, it boosts the strength of your currency compared to the trade balance. It basically makes Americans' import strength stronger, but it makes our export competitiveness weaker. And so basically, that's how we supply the world with dollars, is through a structural trade deficit. And so there's a cost to maintain that system. And so in many ways, that dollar system has really benefited Washington, New York. If you're involved in running the money system, if you're involved in high margin intellectual property, healthcare, tech, that kind of stuff, you're fine. But if you're involved in trying to make things, In the United States, for example, this system has generally been harmful for you. There's like an artificial extra monetary premium on the dollar, which just makes it much harder to operate, with global competitors, let alone developing countries, but even other developed countries. That's why Germany and Japan, for so many decades, were able to kind of take market share from the United States, and eventually it became China and others taking market share. But eventually that runs into its limits. So we've run trade deficits so significantly for so long that we've really kind of deindustrialized ourselves. We have trouble making a lot of our own things. We're much slower at infrastructure than we used to be. We have rising populism, especially if you don't live on the coast and you don't work in intellectual property or finance. If you're more, the people that have been harmed by this arrangement, there's just more populism. So that basically the United States is starting to face some of the consequences of having the system.
Do you see, I'm trying to think how to phrase this because this comes up a lot. Do you have an outlook on will the U.S., how long will the U.S. have that global reserve currency status? I take it that that's very much, I guess when you see a new world or a new order, that's usually when you see like a new monetary order as well. Just want to hear your thoughts. So maybe, I don't know if you have a timeline there or how close we are to that. Because there's all this talk recently of de-dollarization and whatnot. Just want to hear your thoughts there. And I apologize for the poorly phrased question.
So I don't think it's a Boolean outcome. Even when the UK went through their, process, Bretton Woods was the big time where there was a changeover, but it really wasn't until the 1950s Suez crisis that they, kind of fully were realized as having lost their reserve currency status. It comes in parts. Going forward, there's really no currency block that has the capability to be the sole world's currency. Most people think, because of the past two currencies, we assume that the next one is another fiat currency, that some country will just continue to run this ledger. But I would argue that this has been a anomaly that is specifically tied to our current state of technology, which is basically when you don't have a way to do fast settlements, when you have, fast transaction speeds, but not fast settlement speeds. And so you're reliant on somebody's centralized ledger to kind of glue things together. And that's really only been Britain and the United States. Going forward, I don't think there's really no country that has that capability. So when during the Bretton Woods system and during the early parts of this current fiat currency system, the United States had over 40% of global GDP. And they had most of the gold. They were running trade surpluses. They were basically a hyperpower. And so they had the capability to be that ledger. We've diminished ourselves over time as the rest of the world has rebuilt after that era. We're now a smaller part of global GDP, and we're running structural trade deficits. We have a much smaller share of the gold. Things have just kind of distributed more. But there's no other currency block that has 40% of global GDP. Like Europe doesn't have it, China doesn't have it. Both of those regions have more aging demographics than the United States does. Neither of those have the geographical strength of the United States. And so there's really no currency block that can just be the whole world's primary currency anymore. So I think what we're entering is a multipolar world. I think this largely began during the global financial crisis. Since then, there's been relatively little treasury accumulation among the foreign sector. There's been more gold accumulation among the foreign sector. And then with recent events, now we see China buying more of their energy in their own currency, for example. And so I think we're setting up to see just a more diverse currency situation in the world and more reliant on neutral assets, with the current one being gold as the primary one that they go to. And that so it's not something that say, okay, 2 years from now we're going to say, okay, now the world reserve currency's changed. No, it's just it's a gradual shift towards that kind of more decentralized world that is punctuated by moments, like for example the Russian invasion of Ukraine and the subsequent freezing of their reserves, and then them pivoting quickly towards more non-dollar deals with entities like China. Those are stepwise changes that happen, But even then, there's multiple of those types of steps within a longer process of just kind of things balancing themselves out in a more kind of sustainable way.
Got it. Okay, more multipolar, more decentralized. Well, okay, I want to hear more though. I want to hear more on gold and just get your take there. Gold tends to be a pretty popular subject on this show. So just want to hear a bit more because as you point out, there's more of that foreign accumulation of gold. How do you think about gold?
So I'm constructive on it. I've been bullish since about 2018 in my portfolios. And because, you're entering an environment where the overall, like when you have the U.S. government running the debts and deficits it is, even though right now they're running positive real rates, it's hard to do that indefinitely. If you just run the numbers, if you have 120% debt to GDP and very large deficits, it's very hard to maintain positive real rates on that for a long period of time. And I think gold is sniffing that out, or the gold market participants, because normally with this sharp increase in rates, this gigantic bond sell-off we've seen, normally you'd see more carnage in the gold market, but instead it's just kind of been flat for a few years. It's held up, and I think that a lot of participants are realizing that they're unable to remain this monetarily tight while being this fiscally loose, and because of that, that's an inherently temporary state of affairs. And I think more and more countries are, they want to have a portion of their reserves that can't be frozen by one power, or by any power. In this case, if they self-custody their own gold in their own vaults, and it's basically a form of just long-term settlement. So it's not fast. It can't be used as your like immediate reserves. Like you can't just sell it on a random Tuesday to defend your currency in a way that you can do with other instruments. But it's kind of like the long-term part of your FX reserves. And so I think that, the only real competition to gold in that sense is Bitcoin, but Bitcoin is, of course, it's 15 years old. It's far smaller. It's not as liquid. And so at least in this current era, gold is the go-to among, kind of official geopolitical sources if they want to decentralize their reliance on the dollar.
Speaking of Bitcoin, like how do you see the evolution of Bitcoin playing out and some of the challenges that need to be overcome or potential catalysts for Bitcoin for maybe, wider adoption on a global scale?
So as mentioned before, Bitcoin challenges the existing structure because Bitcoin and then to some extent stable coins, they just go around financial borders in a way that prior monies don't. And that is both an opportunity and a kind of a risk from these different countries' perspective. And so basically what we're seeing in the past almost 15 years is just greater and greater monetization. I'm not aware of any other asset that has fallen 75 or 80% in price or more as many times as Bitcoin did and bounced back to new highs. And just kind of kept going from there. You've had this kind of big long-term period of just more and more people understanding Bitcoin, wanting to hold some of their assets in Bitcoin, wanting to build companies on top of Bitcoin that make it easier to use. And so we're basically seeing the bootstrapping of an asset, of a new money, in a way that's pretty unusual. It's kind of like watching the internet build out, except you can also just directly buy a share of the internet. And that's kind of what we're seeing in this form. And so my long-term projection is, basically expecting to see greater and greater liquidity, greater and greater market cap in a volatile way. The bigger and more liquid the network gets, it should decrease its volatility over time, because a lot of the volatility we see is based on, one actor, one little offshore casino, for example, can leverage it up and then blow up. And that can cause volatility. And also when you're in an early stage, any sort of startup company, for example, is basically an option on whether or not that company is going to succeed. It either goes up 10x, 100x, or it fails, right? And so any small shift that affects the perception or the probability that it's going to succeed or fail can dramatically change the price. Whereas, say once Bitcoin's been around for 30 years or 40 years and has reached, closer to its target addressable market, that, just kind of more stabilizes, I think. So I think what we're seeing is the ongoing bootstrapping of a new money. It's being tested for various weaknesses or risks along the way. So far, succeeding them. It's proven to be anti-fragile. So it survived the Mt. Gox hack. It survived the China ban on miners. It survived attempts by its own industry to centralize it with a block size increase. It's gone through these various challenges, and it's kind of remained its core functionality in place. And I think that some of the biggest risks going forward is that when the U.S. government increasingly tries to go after self-custody and privacy, I don't think they really mind people holding Bitcoin in like a regulated silo, like an ETF, for example. But they don't particularly like people self-custodying their own Bitcoin, and they really don't like people making that Bitcoin private. And so I think that's the ongoing challenge. That's the kind of the next phase of test that I think Bitcoin has to go through. But that as long as no one can break it or centralize it, I think it's likely to continue taking market share from other assets over a multi-year period going into the 2030s.
This might be like a bit of a naive question, but it's more of a curiosity going back to like the top of the conversation when you were talking about like the 160 currency bubbles around the world. How does do you see Bitcoin ever being in a bubble, or is that just something that maybe the way it's designed that it won't be in a bubble? Or just curious, just going back to like that notion of like these other ones being in a bit of a bubble.
So the bubbles that exist now are because they're constrained by either bank transfers or ports of entry, which are both very tightly controlled by their authorities. And so to the extent that the internet exists, it's very hard for government authorities to control the flow of information around it. And there's always a bit of a cat and mouse game. The network's always hardening to make its data harder to track. Basically different ways of bringing money around the world or transferring money around the world. But basically, as long as kind of the world doesn't itself get severed into two internets or something, which is possible. But basically now there's not just wires, but there's satellite internet. So to the extent that the internet remains not in a bubble, I think Bitcoin is likely to spread through all parts of that network. And that's just something that's very challenging for authorities to do much about. And the ones that really could go after it, like the United States, are bound by the fact that we have some degree of rule of law. For example, in the 1990s, Phil Zimmermann invented PGP, pretty good privacy, basically open source encryption. And the government didn't like that. They went after him with criminal lawsuits for exporting arms. That's how they went after him. And he said, okay, so then he just wrote it. He wrote the code in a book. He published a book that was a source code and said, well, now it's protected by the First Amendment. It's words and numbers. And the United States actually backed down. And they had to change their laws around exporting, things like encryption. And there's also a case where people would put code, like encryption-based code on a T-shirt, and the T-shirt would say, this T-shirt cannot be exported. It's dangerous munitions. It's like a joke to point out how just certain laws just don't make sense in a certain world. You're now trying to restrict literally just someone's information, something that they came up with and can share freely. And so Bitcoin's kind of in that camp where in order to ban Bitcoin, you have to ban someone's ability to memorize 12 words, or to use open source software. And so the United States has the most kind of economic capacity to go after Bitcoin, but they also have the most checks and balances that can prevent them from doing that. I mean, until recently, during this whole multi-week period where there was no Speaker of the House, the acting Speaker of the House, he actually runs the Bitcoin white paper on Congress's website. He likes Bitcoin. And so for the multi-week period, the acting Speaker of the House, and it's still there, even though he's not the acting Speaker anymore, but literally Congress is hosting the Bitcoin white paper. and there's multiple pro-Bitcoin senators and congressmen and presidential candidates. And so it's just kind of a hard thing to stop unless someone can find a way to just critically impair it or centralize it. It's just kind of growing. And I think it's hard to get into a bubble unless you can make the internet itself a bubble.
Yeah, I have to say, Lyn, I'm just enjoying learning from you. Let me see if I can sneak in a couple more while we still have time. What's your take on the role of central banks in the future in the context of the rise of digital currencies like Bitcoin?
So I think that the smaller ones increasingly get challenged. And I think we've seen that in Lebanon. We're seeing that in Argentina, where if a smaller, weaker currency is unable to perform properly, then things like Bitcoin and stablecoins are more easily to rush in there, and people have an alternative now, right? So because those financial gates are down, you can go around the historical financial borders that existed. It's the threshold for governments to be able to maintain their own currency is higher now. And so central banking was basically a tool to, when the world needed kind of ability, a ledger that would settle, transactions. The government had the strong ability to kind of centralize everything. It's just kind of the way the incentive structure worked. And if you look back in the history of money over the past 200 years, most monetary efficiencies came at the cost of centralization. They said, okay, we can make this more efficient by centralizing it in this big bank. And then we can make that even more efficient by centralizing all these banks together into a super bank, right? And so that's kind of been the history of money. And what Bitcoin represents is the first technology that kind of says, okay, you can have this efficiency, but it's actually more decentralized now. It actually kind of breaks that trend. And so it's kind of inherently anti-central bank technology. But again, it's early, it's nascent, it's being tested. It doesn't have nearly the network effects or liquidity that the dollar system has, that the euro system has. And so it's basically this rising disruptor against these powerful incumbents that just increasingly makes what they do irrelevant, but not unless it gets to a bigger scale. And they only get to bigger scales kind of one country at a time. So for example, these technologies, including stablecoins, can rival countries like Lebanon or Argentina and say, well, if you're going to mismanage your ledger, people are going to flood over to these other monies. And that can kind of just work its way up the chain until we see how the biggest currencies deal with this fact, especially because as the beginning of the discussion went, many of them are going through sovereign debt crises.
Well, Lyn, I know we're out of time, but I have to say it's been such a treat having you on. I want to give you a few moments to share any parting thoughts. Let folks know where they can pick up your book and anything that you want to share if it's following you on social media, subscribing to your newsletter, reading more of your research. Please take the next few minutes to do so.
So people can check out Broken Money on Amazon. That's if you want to kind of get my overall framework for things in one coherent place. I think the book's the best place to start. People can also visit lynalden.com for my ongoing research. I think there's basically a thing to keep in mind is that this is like a unusual macro situation. It requires out-of-the-box forward thinking, but also being sober-minded about it, right? So I try to push back on sensationalist type of things when I see them that if I don't feel like they're connected to evidence or reality. And it's also important to just be humble because although we have playbooks and historical examples for how these things turn out, every era is different. Every era has a new set of challenges, technologies, geopolitical realities. And so we live in an unusual macro time, and it requires both research and humility to try to navigate this in a way that, protects your portfolio, protects what you're trying to do, and trying to make the most of it, and just be a source of kind of truth as we navigate kind of increasingly polarizing and challenging times.
Lyn Alden, founder of Lyn Alden Investment Strategy and author of Broken Money. Thank you so much for being so generous with your time, your ideas, and just all of your knowledge. Really appreciate you taking the time, Lyn.
Thank you.